Hi, Barbara Friedberg here. Today we're going to be comparing Robo-Advisors versus target date funds and helping you decide which is best for you. What's the allure of a Robo-Advisor versus a target date fund? Simple, easy investing. They're similar, not identical. But if you are someone that does not want to fool around with your investments, picking and choosing funds or stocks, well, then you need to watch this video. So let's begin. We'll spend a few minutes talking about what a robo-advisor is, what a target date fund is, comparing them, pros, cons, and then helping you decide which is best for you. We'll also show some examples of both target date funds and robo-advisors so you get a real hands-on experience about what each of the platforms are. So how does a robo-advisor work? A robo-advisor starts simply with an onboarding and profiling quiz. So in other words, you typically start by answering a series of questions about your financial situation, your investment goals, and your time horizon, how long you're investing for, and your risk tolerance. What are you going to do if there's a market drop? Are you going to be totally freaked out and scared and want to sell all your investments? And then from the information you input, the robo-advisor constructs an investment portfolio for you. It will be diversified. It will include a mix of stocks and bonds, typically exchange-traded funds. And the asset allocation or mix of these stocks and bonds is going to fit with your risk level. So if you're 20, you don't care if your investments go down 30% during a market drop. You've got 40 years until you want to retire. Then you're going to want an aggressive portfolio, which will have more stocks and fewer bonds because you have greater chance of gaining higher returns over the life of your investment. Whereas if you're older, like I am, and getting closer to retirement, you may want a more conservative fund. Just as an aside, I do have an account with Schwab Intelligent Portfolios Robo-Advisor. So I'm not biased, I'm not selling one or the other, but I am letting you know. And then over time, as the mix of your assets deviates from your goal, the percentage of stocks and bonds, the platform will automatically rebalance them back to your preferred allocation. The dividends are reinvested, and sometimes there's something called tax loss harvesting, which in a taxable account will help minimize your tax payments. So what are the pros of investing with a robo-advisor? It's totally set it and forget it. You take the quiz, they give you the investments, and then they do all the rest of the heavy lifting. But you might ask, well, what happens if my goals change? Well, if your goals change, you can go in and you can switch up the asset allocation. And typically you can do it either manually or by retaking the quiz. Robo-advisors are typically low cost, from free on up to 0.7 or so % of assets under management. There's limited barrier to entry. Some of them have no minimums. Many robo-advisors have very low minimums, $100, $500, $1,000. And there's some that'll require you to have, say, $5,000 in order to begin investing. They're diversified, they're convenient, and they're personalized. The portfolios fit with your goals and your risk tolerance level. Now, the disadvantages are, although some robo-advisors do offer access to human financial advisors, not all, they're less flexible. You can't pick and choose the funds that are in there. With the exception of Wealthfront, which we're going to discuss, and a few others, you can't pick and choose or add individual funds or stocks. Now, this is not the case with Wealthfront, and we'll talk about that. So what's a target date fund? A target date fund is based on, they were designed primarily for retirement, but they can also be used for other longer term goals. And they're a type of fund which is designed to simplify retirement investing. Their target date is the approximate time that you will be retiring or withdrawing the funds. And here's how they work. They have what's called a glide path. And so as you get closer to the target date, the mix of stocks and bonds and different types of assets shifts to begin more aggressive initially and becoming more and more conservative as the target date approaches. Then There's automatic rebalancing during certain periods, and it is a set it and forget it approach. The benefits of target date funds are super simple. You just buy one. Let's say I'm, 50 and I want to retire at 60. It's 2025 now. I'll buy a target date fund that has a target date of 2035, and it will be a little more stocks, a little less bonds now, and it will grow more conservative as we reach that 2035 retirement date. Now, it's not personalized, and the glide path might be a little too aggressive for you. If you're 20 and the target date fund recommends 90% stocks and you don't like that much volatility in your portfolio, the target date fund might not be the best option for you because you can't impact the glide path of the fund. There are underlying fund fees. So you pay a certain fee, usually it's a percentage of assets under management for the target date fund. But then within that fund, there are a variety of different exchange traded funds, such as a stock fund, bond fund, U.S., international, maybe a real estate fund, and then you'll also pay the fees of those as well. But actually, that's the same with a Robo-Advisor. You're going to pay the management fee, but then every fund that the Robo-Advisor owns also has a small expense ratio as well. But in both cases, with Robo-Advisors and target date funds, you'll find the fees of the underlying funds are generally very reasonable. Here's a quick comparison chart. And so you can see in front of you the differences between a Robo-Advisor and a target date fund. The personalization, Robo-Advisor is a little more personalized to your risk profile and your goals. And the target date fund is just based on a general retirement timeline. In terms of control, there's more flexibility in adjusting your risk profile with a Robo-Advisor than there is with a target date fund. A Robo-Advisor can be used for a variety of investment goals, and although a target date fund can as well, it's not designed for that. For example, if you have a child that's going to college in 10 years, you can buy a target date fund that has the target date 10 years from now, and that would work as well. But in general, target date funds are really geared for long-term investing. Human interaction, that means access to financial advisors. Robo-Advisors, some have them, some don't. Target date funds, you don't have any contact with a financial advisor when you buy a target date fund. Fees, they vary from free with Robo-Advisors on up to say 70 basis points or 0.7% of the amount of money you have invested. Target date funds, you have to really be careful of the fees because they vary, and I would recommend that you choose a target date fund with lower fees. And we'll see a list of target date funds in just 1 minute. If you're in a higher tax bracket and you're investing in your Robo-Advisor in a taxable account, you might prefer a Robo-Advisor that offers tax loss harvesting. Now, a target date fund is generally less focused on tax optimization. Let's take a look at one of the most interesting Robo-Advisors and also one of the oldest. Wealthfront was founded in 2010, and it's come a long way since then. It is a totally digital Robo-Advisor, but it does have an amazing AI financial advisor, which is programmed to answer 10,000 retirement and financial advisory questions. It follows the model that we discussed of taking a risk tolerance quiz and then investing on your behalf in a diversified portfolio of stock and bond funds and other types of funds. For example, if your risk score was 8 out of 10, and here's a sample portfolio, you'd have 45% invested in stocks, these are U.S. stocks, 18% in foreign stocks, 16% in emerging market stocks, 3% in high dividend stocks, 12% in corporate bonds. And then if you want to see a portfolio, and this is really cool, let's say you're more conservative. There's a slider and you can look at, let's say you have a more conservative risk profile. And so you'll notice that in the bond category, there's 24% invested in bonds and 12% in tips, which are a type of inflation bond. So that's 36% overall in bonds, which Wealthfront will rebalance this portfolio for you. They will engage in tax loss harvesting, and they have a whole bunch of other features that I really like. Their management fee is 0.25% of all assets managed, and I would say this is the most common management fee you will find with most robo-advisors. So let's just look really quickly at some of their other features, because I think this is really nice. If you want an automatic bond ladder, let's say you're older, you're just looking for income, you can get an automatic bond portfolio. Or let's say that you want to add some stocks to your portfolio for Wealthfront to manage and rebalance. You can do that as well. We'll go take a look at my Schwab Intelligent Portfolios. Again, I'm not recommending this. Now, Schwab's a little different. In their automated portfolio, they have a lot of assets, from 12 to 20 in each portfolio. And there's many variations of different types of portfolios that you can get based on your risk tolerance and your preferences. Now, they do not charge an overall management fee, but here's the catch. Because they don't charge a management fee, they do require you to have about 8 to 10% of your investment in cash. And what that means is they get paid through you holding the cash. And the cash is in a high yield account, which is fine. But if you don't want to hold cash in your portfolio, then Schwab's automated investing is not going to be for you. So they have a choice within the portfolio. And when I say a choice, you don't choose them. They choose the portfolio based on your risk level and your future goals. But it's very diversified. There's about 20 different asset classes. There are 3 different strategies: a global, which is the one I have, a US focused, and an income focused. And then there are 6 risk profiles. Now, what if you don't want to forego the opportunity to have a financial advisor, but you don't want to pay 1% or more to have your assets managed? Well, that's where a combined hybrid Robo-Advisor target date fund come in. And Schwab Intelligent Portfolios Premium is an example of one of those models. What I like about this option are the fees are extremely low. The portfolios are similar to those in the automated, and with the Intelligent Portfolios Premium, you have access to a financial professional to talk about your investments. And the fees are the standout. You pay a one-time planning fee of $300 and just $30 monthly for an advisory fee, no matter how big your portfolio is. Schwab Intelligent Portfolios Premium is a decent option if you're looking for a robo-advisor, but you also want access to a financial advisor. The fees are very, very reasonable. And the larger the portfolio and the more assets they manage, obviously, the lower that $30 a month payment is in terms of percentages of your total investments. Now let's take a look at target date funds and how they differ. This is the Vanguard website, and I'm not recommending Vanguard target date funds. And in a minute, we're going to get to Morningstar, which is a wonderful investment research platform, and they're going to give you a list of some of their favorite target date funds. But in the meantime, this graphic will help you understand exactly what a target date fund. This is your age on the x-axis. So if you're, and this is your percentage allocated to each of these different investment categories. The light blue are stocks, the US stocks, the medium blue are international stocks, the mustard color are US bonds, and the lemon color are international bonds, and then this beigeish color represents very short-term TIPS or Treasury inflation protected securities. You'll notice when you're 20, if you are in a long-term target date fund, when you are 20, you have a very large percent in US and international stocks, almost 95%. And actually, it stays very similar until you are 40. I'd like to make an aside because I've been a conservative investor since I've been in my 20s, and I would never be comfortable with this higher percentage of stocks in my portfolio. And so that's one thing you have to take into consideration. And if you are not comfortable having this greater percentage allocated to stocks in your investments, and you do want a target date fund, you might want to take one that has a shorter time duration. For example, a 10-year target date fund, because that will be more conservatively allocated. So then as you move on, here you are at 40, as you move on to age 60, the next 20 years, you'll see a dramatic reduction in the percentage of stocks. As you get to be 65, many people retire at age 65. You're pretty much at a 50% stock, 50% bond portfolio. And on down till you get older, when it levels out at age 72, and you're at about 25% stock allocation. The Morningstar website ranks a bunch of different target date funds. And remember, they all vary. Their fees vary, their glide path varies. So it might be a little work in the beginning to choose the right target date fund for you. But then once you've picked it, you're done. You don't have to do anything. And here we've got from highest medalist rating to more neutral. And so I am not recommending these. This is Morningstar's recommendations. And so if you are interested in taking a look at this, you can go to the Morningstar website. All right, let's wrap it up. Which investment path is right for you? Do you want to consider a Robo-Advisor, or do you want to consider a target date fund? If you're seeking low-fee investment management, then you might want to choose a Robo-Advisor. They have a diversified investment portfolio based on your goals and risk tolerance. If you are okay with a digital platform, or you're willing to pay a little more to get a hybrid platform with human guidance, then a Robo-Advisor might work for you as well. They also offer tax loss harvesting, and you can tweak them more to fit in with your short, medium, and long-term investment goals. Therefore, you can adjust your risk tolerance over time. Now, a target date fund might be right for you if all you want to do is you want to save for retirement. You want a simple, hands-off approach. You like the idea of just set it and forget it. Many people have a target date fund as the default option in their employer-sponsored retirement plan. If that is the case with you, well, then it's a no-brainer. You'll choose the target date fund. And if you really don't need a highly personalized investment strategy, then a target date fund might be great for you. Now, of course, you could consider a hybrid approach. You can use both options. You can have a target date fund in your workplace retirement account, and you can open up a Robo-Advisor for the rest of your investing. Ultimately, the final decision rests with you. Investigate both options, look at fees, look at your personal situation, and decide whether a target date fund or a Robo-Advisor would be best for your hands-off investment approach. I'm Barbara Friedberg. If you like this video, please give me a thumbs up. Share it with your friends, subscribe, and if you do click on any of the links below that are mentioned as affiliate links, our company might get a small commission that will help us fund this channel. See you next time. Bye.